The tax planning mistake number 2 is your failure to maximize your 401k, your simplified employee pension plan, your simple IRA, or your IRA deduction for business owners so that you can try to maximize your retirement contribution. And we also typically want to minimize what we pay the employees. I mean, I'm just saying we're just not that generous. Most business owners are trying to save taxes, but the problem you have sometimes is that if you try to maximize your pension contribution, you might be, all the tax savings might be going to your employees because there are minimum requirements you have to have with a pension plan to contribute money for your employees. But a pension plan, I believe, is the best tax shelter out there for business owners. For my lady from Fort Thomas, the example was that, well, you won't save Social Security taxes, but if we take 15% off of 46, you're at least saving a third in income taxes today. So that we give her motivation, if you think about it, that if I do put $10,000 into a pension plan next year, so I can make more money, and to avoid taxes, I put it into my retirement account and I save taxes, I only have to pay 15%. I like that idea. Okay? So again, the thing that I would focus on that's out there that's also a misconception, I believe, is a lot of people are out there advocating that you should have a Roth IRA. The people that are advocating that are a lot of times financial advisors that are not tax advisors. And having worked on this a lot since they put the Roth IRA in 30 years ago, I found that if you're the question becomes, do you believe that you're going to be in a higher tax bracket when you retire? Now think about that. I don't have many clients that retire with an IRA account over $1 million. Let's assume that you would be very successful and you try to put away money in and year out. Do you think you're going to be able to accumulate over the next, till you're retired, $1 million in your IRA? So you're going to take that money out when you retire? Let's assume that you are successful in doing that. And when you're age 70, you're required to take out the required minimum distributions. It's 6%. So if you're married, you'd be able to take out $60,000 a year. Now, we just went through the tax brackets. You have Social Security typically in your IRA. Are you in a higher tax bracket when you retire? Keep in mind these tax rates have been indexed for inflation the past 30 years. Okay, so while that's the thing that, because I've been practicing over the years and I've experienced it, these tax brackets keep getting larger at the lower tax rates. So the whole assumption that you're going to be in a higher tax bracket when you retire for the average person defies logic with me, which says you would not need a Roth IRA. Okay? You would want a tax-deductible IRA because you're going to be saving taxes at 25%, and hopefully you're going to be in a 15% bracket. Do you really think that Congress is going to be taxing retirees at a higher rate when in your 70s? And by the way, let's say you're in the same tax bracket. Guess what? It's a break-even. It's a wash. Doesn't matter. You have to be in a higher tax rate to lose on this deal. There's one other factor that people don't talk about. We do a lot of elder law planning. What's that mean? Age 65, the baby boomer. Your average life expectancy will be age 83. 1 out of 4 will live to age 90. 1 out of 10 will live to age 95. That's in my Social Security statement I just got this year. Also the statistic, 2 out of 3 people age 65 will be needing nursing home care before they die. And we all know what the cost of nursing homes are currently. And usually it's end of life, quite frankly. It could be a year or two. The average stay, though, in a nursing home is 4 years. The American Institute of CPA has a guide for elder law planning when I'm working with clients to do retirement planning. You should budget $250,000 at age 65 to plan for your medical expenses from age 65 during your retirement years. If you're married, you need $500,000. Now, how does this tie back to the IRA? We work with clients all the time that they accumulate money in an IRA, and when they go in the nursing home and they're paying $100,000 we take that money out. And guess what? You get a medical expense deduction on 90% of your nursing home care cost. Guess what? I want a pool of money in an IRA that I can do some financial planning and tax planning when you're older, that you can have more money to pay for the nursing home. That's the whole strategy. I do encourage clients, if you do a tax-deductible IRA, to put that extra money that you're saving in taxes into the IRA so you have a bigger nest egg, okay? So, you know, if you're, in this example, if you did a Roth IRA, you'd be doing after-tax money at $10,000. Well, I don't want you to do that. I want you to go ahead and goose it up another $3,400. If you're over age 50, you can put $6,500 and $6,500. If you're a married couple, you can put $13,000 into IRA, tax-deductible IRA. So that's the example I'm giving you, that I want you to maximize what you can put into. I want you to take the tax savings and I want you to put it into the IRA. So the tax planning mistake number 2, where you don't maximize your pension contribution, I think that's something you want to review with your CPA. As a business owner, you're typically trying to balance things out. I'll give you an example of my situation. I have a simple IRA. Now, I could try to put more money away into maybe a 401k with my employees, but guess what? With a simple IRA, my minimum contribution for all my employees is 2%. So there's actually a cost that I have for me to put, you know, $15,000 into a simple IRA. And I'm going to save, what, $5,000 in taxes. My payroll is nearly $400,000. You know, what I'm trying to tell you is that I'm putting money away, but guess what? All my tax savings is going to my employees. Now, if I did a 401k, I'd have to put 3% in. Okay? So I'm giving you an example that most of the business owners I talk to, we're trying to do strategic planning, and we have to look at the overall picture. So in my situation, the simple IRA allows me to put some more money in, but I wanted to contribute, and my employees have been with me for a long time. It's part of their compensation package. That's how I look at it. So when I do their annual review with compensation, we have their income, bonuses at Christmas, and then we also look at the health insurance that I pay 100% of. We'll be talking about health insurance cost. Is another thing that business owners need to deal with their employees. So I think for your purpose, I don't know if you check the box, yes or no. Is that something that you need to talk to your CPA about?